Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, Andrew. Things I can see the palms swaying in the wind as always.
Yes, they are. Thank you. Yeah, today is, I would say, probably the first nice day of spring in London. Um, so everyone's very excited about that. We were outside at Kew Gardens today, and now back, very excited to kind of run through everything that happened over the past week. So, as we always like to do, let's kind of have a recap of everything that took place from data, price action, any kind of Fed government speeches, and anything else you want to kind of focus on.
Sure. So let's start with the Fed, our beloved Fed. They were in pre-meeting blackout, so not much comment, but there are a couple of interesting data points. So first of all, the First Republic saga. This is like the gift that keeps on giving. It's still not resolved. There was a not very polite article in the New York Post singling out Yellen for criticism as, head of the Treasury. Obviously, there are many cooks involved, the Fed, the FDIC, but the bottom line is we need resolution because this thing otherwise could fester and trigger another bout of panic. And this week, this past week, so this is the data we got on Thursday, Fed lending to banks increased. I mean, not much, 11 billion. Money market fund assets that had been falling the week before and are a poor mirror image of deposit flight. I mean, the correspondence is not one-to-one. But last week, asset fell, and this week assets increased again. 54 billion, which is not that much for money market funds, but we need resolution. All these things has a potential of, snowballing and basically, once again, throwing all my macro forecast in doubt. So I need resolution here. If one of our listeners could reach out to the people involved, the Treasury, Fed or FDIC, that would be much appreciated. More seriously, what was interesting, though, is that the bank data showed that loans continue to increase, both at small and large banks. I mean, this is from a week ago. But again, no sign of credit crunch. So that's a Fed.
Just a quick question on so money markets, that's people saying, I don't trust my money. And especially my money above 250,000, just in a regular checking or savings account. So I'll put it into a money market, not affiliated if that bank went under, that's in an investment account, and that should definitely be protected. Well, what would be a number that's high for a week that flows into money market for people to think about? 100 billion?
Yeah, maybe.
Okay.
Yeah, or a sequence of 100 plus prints. Because the bottom line is, if you look at the quantity of money market fund assets and deposits that we have in the economy, it's still close to historic high. A lot of those liquid assets were created by QE, basically, and we had insane amounts of QE during the pandemic. So people have too many bank deposits, quasi deposits. They are substituting into longer duration assets, riskier assets. So you'd expect that number to go down on aggregate. So a continued increase in large increases in money market fund would suggest that, yes, people are worried.
Right. And then because it doesn't really look like, if you look at KRE, I guess at the medium or small bank ETF, or even just the general markets, it doesn't look like there's panic. What could First Republic, how could that cause a wider issue? Well, what are you concerned of there?
So if the resolution, so it's clear it's not viable as it is now. So if the resolution was handled in such a way that it shows the government is not going to indemnify all depositors, then all hell will break loose.
Right. We're
Not
assuming that's
it,
not going to happen. We're assuming they'll be there. Yeah.
especially since 30 billion of their deposit happen to belong to the biggest US banks, as
So
we
we're
know.
doing a favor, right? They're not going to be happy.
Not going to be happening. But a sense that the government doesn't have its act together and is not able to stabilize the banking system. So continued hesitation, mixed messages. It could, so people have the memory of the GFC very fresh in their mind, and they could easily be triggered by some small government.
Right. Okay, perfect.
So in terms of data, the data in general was good. I mean, the GDP number, the headline number, 1.1% was below expectations, but this was largely because of another huge swing in inventories. If you strip out inventories and external trade, net export, because the two tend to be quite correlated, net export go up or imports go down when inventories decrease and vice versa. So you strip out the two and you get 2.5% compared with a trend growth of 2%, which is good.
Right.
So that was quite strong. Then we had the wage data.
And the markets reacted, despite what you would read in the newspaper, including the ST. The markets kind of reacted more along your lines, which the market took that as actually a fairly strong number.
Well,
I saw bonds kind of sold off initially. Yeah.
The day before, I had warned clients that the final Atlanta Fed was 1.1% entirely due to huge inventory swings. So I'd like to think we at Macro Hive had a little role to play in that reaction, but
Right.
who knows?
Yeah.
So market reacted well. Then we had the employment cost index that was a tad higher, as I expected, than the consensus, and shows that wage growth, nominal wage growth, is not slowing. And if you set it against marked slowdown in headline inflation, real wage growth is still increasing. You see it in the GDP number with the share of labor income in national income going up and the share of profits, which in my view, given the strength of demand, could very well set up the stage for a recovery in margins in the second half, with businesses raising their prices, which, by the way, is exactly what John Turney found in his review of corporate results, that firms still have a lot of pricing power and are able to pass on the increase in their costs to their clients. So to me, this doesn't.
And so if wages are not going up fast enough, but yet margins are still widening, that just means there should generate a lot of extra liquidity, or businesses and individuals have extra cash to spend, which they will continue to, or have taken leverage on, and be able to kind of.
No question. I mean, household income growth was higher than expected. I mean, by 10 basis points. But if you look at the trend of real income growth, it's up actually, and it's adding momentum to the economy, which is not exactly what the Fed is looking for.
Right. So I had one question about last week. Most of the data looked pretty decent on growth, like you said, at least say decent or more. Most of the inflation data came out in line or higher. Why are bonds yields, I think, are the same or generally lower across the curve over this past week? Is it just because the market's still assuming there's something like sinister that's about to happen? I guess there's the debt ceiling, there's some big, massive cut in banking and credit from medium and small banks, something. But are you surprised the bonds, fixed income, not selling off? I guess what it looked like was cuts are definitely getting very short-term cuts are getting priced out, as we
Yes.
said and talked about that we should have those trades on. But generally, like 2-year yields aren't really going much higher, and the back end is also kind of holding near the lows in yields in yield terms. Are you surprised by the market reaction to the data this past week or even the last couple of weeks?
So in terms of 2-year yields that are more closely driven by policy, which is really my, my expertise. I mean, since the Fed itself is saying that they are going to stay on pause despite these very good growth and strong inflation numbers, it makes sense for the market to believe the Fed. The market has a tendency to like things that are, for good for the markets. The Fed has this very strong reputation and track record of being incredibly dovish. I can't see, I have yet to see the market get ahead of the Fed in terms of pricing rate hikes. I mean, there is more of a propensity to price desired cuts than the dreaded hikes.
Right.
So there could be a bit of a Fed guidance here, market psychology, maybe, I don't know, some positioning at play.
Yeah, I guess if you look at like possible paths, if you actually look at it like a Monte Carlo simulation or something, and you say the much worse inflation will not force the Fed, at least for the next couple of months, to probably hike much more, maybe an extra 25 after this one. But no matter what, they'll assume to wait and hold. But if something very negative happens, if you look at history of how they've reacted, and this Fed doesn't look any different, is they will cut significantly and quickly if they need to. So if you put all those past potential, and they're saying we're not going to move at all, most likely for a long time, all that together should fit with the 2-year around 4, maybe a little bit higher, but it doesn't need to be at 5. And obviously, no reason for it to be, well below 4. But I guess that maybe a bit higher than where it is what we would think.
So yeah, basically what you're saying is that the market is averaging 2 extreme scenarios. Does that make sense?
Yeah. Yes. And assuming that one extreme scenario is just much, much more likely than the other extreme scenario. Or the Fed reacting, Okay. And to be honest, I think you see something similar. In Europe, actually, yields have been coming back up. And actually now that the spread's narrowing again between US and Europe, because they're experiencing similar kind of thing. Growth is definitely not as bad as people were expecting 2 months ago, and inflation is basically stabilizing at high levels. It's almost European yields makes more sense, I think. But I guess the difference is also the US has this issue around the debt ceiling. So.
And the banks, which is
and the bank, yes,
and still unresolved.
Yeah. Okay. Awesome. So, and then for the upcoming week, so let's go through everything. Yeah.
Okay. So the Fed 25 basis point on hold, but Chair Powell is going to note that the credit crunch has yet to materialize. There is a chance he will probably say, and if disinflation does not happen, we are prepared. Well, we would consider, he's going to use a very hedged statement to hint that it's not all love and kisses, that if inflation doesn't come down, there will be some tough love on the horizon, and they will do what's needed to bring down inflation to target, blah, blah, blah. We've heard it many times before. So that's the Fed. One piece of data, which we are going to get early next week, is a Fed survey of senior loan officers. It always gets released before the FOMC. And this one is important because it's going to give us a sense of the tightening of credit conditions, because it's a qualitative survey sent to loan officers at big and small banks, asking them, have you tightened conditions? It's also going to ask about demand for various type of loans. So that one will be very informative. And by the way, we are getting it on Monday or Tuesday. The Fed probably got it in real time. I don't know when they carried the survey, or probably they must have rolling surveys to keep abreast of the risk of credit crunch.
Okay. So you'll write some analysis or something on that.
It will be on
so everyone at Bloomberg and stuff, all pro client stuff.
Yes.
Okay.
At the same time as I do, absolutely. And then of course NFP Friday, wonderful. So I'm okay with the consensus. I mean, they see quite a decline, but that's fine. I mean, who knows? This number is so volatile. The decline is 236K last month. The consensus thinks it's 170K. Even 170K, if you look at it year on year, you still have labor demand, so employment, outstripping labor supply to almost 2.5 times. I mean, labor supply is growing at about 1% annual rate. And the sort of numbers we're talking about here, it's about a 2.5% growth for labor. So it means we continue to have a super tight labor market. I'm continuing to expect a recovery in participation. And actually, I think now we are within 1 full percentage point of the pre-pandemic participation. So the recovery is actually going well. And by
that should be good. That's good for everybody in general.
That's good for,
that's a number that a lot of people, I haven't seen it, but in the UK, everything I feel like I read is participation level in the UK is much lower than it was for a variety of reasons. So if the US, if it's within 1% of where it was pre-COVID, that's pretty good.
It is pretty good, and it's rising. And I think it's directly linked to the increase in the savings rates that we've seen. And that increase in the savings rate is that basically a growing number of US households have spent all the government money. And so they are going back to normal patterns of work and, income, spending, saving, all that. So contrary to consensus, I think we're going to see another small increase.
Because I remember the Jamie Dimon's comment was, and obviously this was from a couple of months ago, but he said that their numbers were somewhere around the midsummer, that people will really start basically running out of all the stimulus money, and that will start significantly affecting behavior. Now, obviously that could move by a couple of months. But we could be heading, that definitely probably is affecting that labor participation. So that's it. Yeah, that would be an interesting number that everyone should be looking at.
Definitely. So hopefully no big surprise here. I'm okay. So I'm okay with 170K, though, I'm looking at the surprise in initial unemployment claims this week. And for the past few weeks, there has been a big disconnect between seasonally adjusted and not seasonally adjusted number, with the latter much stronger than the former. So I'm wondering to what extent the perception of weakening labor markets, though still very strong, were not influenced by seasonality, which, as we both know, is quite spurious. But anyway, we'll see. The other data we'll get on the labor markets, this is on Tuesday, we'll get the JOLTS. And as always, I don't put much weight in the headline opening, simply because hires are much, much smaller than opening. But the two data I'm looking for in that release are the quits rates and the layoff rates, and both are stronger than before the pandemic. So the quits rate is still higher, which shows that the labor market is still stronger than before the pandemic, and the layoff rate is still lower than before the pandemic. So I'm looking for continued small declines of those, small declines, but I expect them to remain stronger than the pandemic. So basically what I'm looking for this week is signs that we have a labor market that continues to normalize, but because of the absolutely crazy scale of policy easing we had during the pandemic, the normalization is from the top rather than the bottom. So we're sliding towards trend. Then it's the beginning of the month. So of course we have the PMIs. And the consensus sees them moving sideways, which makes sense. I mean, if I'm okay with it. If anything, there is a risk of a downward surprise. What's been going on is that we've had a divergence between the ISM PMIs and the S&P PMIs, with the S&P, both the services and the manufacturing PMIs being stronger with the S&P than the ISM. And I think it reflects the difference in the sample. The ISM is mainly very large firms, while the S&P has a broader range of firm size. And it looks like, all the layoffs that we are talking about are happening at large firms.
Okay.
Tech. So it's not impossible that the ISM PMI show a downward surprise, because it would be a continuation of that divergence with the S&P. But nothing that's going to make me change my view on the Fed or the economy, or the surprise would have to be really huge, which is unlikely.
Right.
Yeah.
Yes, sir, Dan.
No, I was going to just say a few words about consumer credit. I think the market is a little too optimistic there, because actually people are borrowing less than they were during the pandemic. For the reason we just discussed, their income is normalizing.
Thank you. That's great. One question I had before we kind of start wrapping up is, what possibility are you giving for the Fed to have one more 25 basis point hike after this one? But we're assuming this is like close to 100%. So the following month, what would you give?
At the moment, 15%, because doves, the doves are very strong. I mean, we have Governor Cook, we have Alston Goldsby at the Chicago Fed, and they are saying, a credit crunch is coming. So let's look at the senior loan officer survey on Monday or Tuesday. It's going to give us a sense. Obviously, if it doesn't show much incremental tightening of credit conditions, that increases the risk of another rate hike over the summer. But I really think that Chair Powell is hamstrung by the doves. So,
Right.
Yeah.
So most likely scenarios, one more hike, and then on hold through the summer, and maybe if this kind of data, which we most likely think, barring something huge happening like the debt ceiling issue, maybe Jackson Hole kind of then changes the tone again, the narrative back towards, we haven't actually beat inflation. We gave this a few months, it's not coming down. We need to continue to address these issues, and then hiking could start again in the fall.
100%. Yeah, I completely agree. One thing I think we should mention for our listeners is the debt ceiling.
Yes.
So the Republicans who control the House passed a bill with a majority of 2 to raise the debt ceiling in exchange for very drastic and, to be frank, completely unrealistic expenditure cuts. The reaction of the administration was Congress should raise the debt ceiling unconditionally. So basically, they don't want to discuss, which means, this is what we've been talking about for quite some time. Resolution is only going to happen close to the X day when the Treasury really runs out of cash, which is probably in the latter part of August. And it will be preceded by rounds of brinkmanship, since, this is the administration strategy that I think the Democrats are a little tired. They've been, too compliant, too well-behaved in past episode of debt ceiling standoff. This time around, they want to be tough. And so it means a fair amount of volatility around the resolution. But the thing to remember is that if the United States want to score investors, they can do it with higher inflation, weaker dollars. They don't need to go the Russia way of announcing, one day your debt is worth 80 or 50% of what it was. That is not going to happen. So it will get resolved. It's just that the resolution could be quite bumpy, but the other thing to keep in mind is that if we end up having some serious disruption of financial markets, especially the treasury markets, the Fed will step in just like it stepped in, in all previous episodes. We don't want to go through the list now, it would be too long. But so we are going to have possibly more Republican initiatives because, they are getting a little flustered that they are being ignored by the administration. And this is, after all about electioneering. The administration is now going around telling the American people, look at the Republicans, they want to kill Social Security, Medicare, actually they just want to cut discretionary spending, not entitlement, but that's a different story. But so you're going to have electioneering with one side saying, look at what the administration is doing to our children, grandchildren, grandchildren, the debt burden, blah, blah, blah.
How would you see this resolving?
So I think we get to the X day and we get some very last minute negotiations going on. I don't think the Republicans will do well in the sense that they won't manage to get very big changes in fiscal policy. I think it actually gets resolved in the polls, because what the administration is doing, even though President Biden himself is not very popular, people seem to like his policies. The administration is obviously, the whole plan is to turn around and tell the American people that, their favorite programs will be wiped out by the Republicans. So there is a good chance that by the time we get to the X date, the polls suggest that it's the Democrats that are benefiting from the standoff more than the Republicans. And I think that's what gets the thing resolved. But I wouldn't rule out a technical default. As I said, the US is not Russia, but it doesn't mean that we are not going to go into a technical default.
Right. Okay, awesome. Thank you. Thank you as always. And just quick recap on the stuff from this past week. We had as we always like to have, our prime trade ideas, which is a great collection of across assets, including asset allocation thoughts, is put together, which all our prime clients and certainly our life clients should check out. Those are ideas for strategic ideas, but also kind of portfolio, kind of medium, longer term ideas as well. So it's definitely worth looking at. Richard has a great take on currency indices, what it means. I'm sure not always like the most sophisticated investors hear professional investors talking about things like indices or currency indices. How do you use them? What effects can it have on the markets? On the professional side, your partner in crime, Mustafa, in his Global Rates Weekly, actually is saying why banks may actually be in I guess US bank, why kind of more medium small banks, why they may be in actually worse shape. I guess I saw one of his presentations talking about pressure on NIMs. And that obviously, again, will take time to play out, but that can have an effect. And also maybe affecting yields.
Well, Mustafa, go.
Yes, exactly. Everesh on the Oil Weekly, which is great. And actually, question that many of our clients are asking is what could push oil prices outside of this fairly tight range? By the way, to reiterate, a piece he and I wrote about a month ago was relatively bullish, but we didn't see a massive move in the near term. And that's continuing to kind of play out. Those are like 1x2 call spreads with selling puts on the downside. But it is a great question to ask what would push oil outside of these current tight ranges. An update on the modern portfolio, which since inception, annualized return of 17.8%, which really is amazing from you and everyone on the Bilal and everyone on the teams have had some great trades, 5.8% year to date returns. Everyone should please check that stuff out. Dalvier gave, which is continuing to increasingly become an important focus for us, is better understanding realized and implied vols, looking at and analyzing different methods of assessing realized vol, outstripping the effects of specific kind of data events to then feed back into how to better understand applied vols, all of which most dollar vols showing that implieds are pretty cheap now. Certainly versus realized for a lot of the past year, and that's across most of the dollar pairs. That's a super interesting piece that he put out this past week. That's kind of it for me. Any parting words for all your fans?
As always, please keep the feedback coming. Negative feedback, particularly helpful and very welcome. And good luck out there on the markets.
Boom. Thank you so much. And also good luck to everyone. And as always, please feel free to reach out to us on Bloomberg or email, even through the website. And hope everyone has a very enjoyable and successful upcoming week. Thank you.
Thank you, Andrew.